Hi everyone, this is Rob Roy and welcome to the Elliott Wave Elite US Market Update. Before we get to the charts, I'd like to say I would hope everybody had a very Merry Christmas and is enjoying a happy holiday season. Boy, the market certainly didn't want to kick us off to the Christmas holiday in a very festive way with a very surprising downward move on Christmas Eve. I say that because the downward move that occurred on Christmas Eve was the worst Christmas Eve in the history of the market. That's saying something. The worst Christmas Eve in the history of the market. As we take a look at the chart of the SPX with the Elliott Wave pattern put on it with the indicator tool, it shows that we are now in a 5-wave directional trending pattern to the downside, with the current move down being in the wave 3. In the past, we've gone through and I've labeled this first zigzag and the flat several times. If you're new and haven't seen that, go look at some of the past recordings and I've labeled all that. I want to focus on this current impulse pattern and the odd things that are occurring right now in the market. So just to refresh your memory on where we are currently, we started with this impulse pattern to the downside with the initial impulse A wave down, and then we had a corrective move right back up to the 50% level. That happened quickly. So you can see right there, the correction happened quickly, he tried to say, right back up to the 50% corrective level, and then we put the Fib extension tool on. But before I do that, let's talk about where we are right here with this current pattern in the market. We can see that we have a wave 4 bounce that's set to go right here with a wave 5 extension down here. Now, if I go ahead and put a mark, because I don't want to have too much stuff on the charts, otherwise it gets confusing with all the lines. So I'm just going to make reference to where that wave 4 is, and then as we come down the wave 5 target, the top of the wave 5 is here, with the midpoint of the wave 5 being just a bit lower right here. So I'm just drawing these lines off to the side so you can remember those as I put the wave extension tool on. So I'm going to go ahead and take the primary Elliott wave pattern off, and then let's look at the extension for this current zigzag pattern that we're in. So we measure the A impulse, and then we come back to the B extension, and you can see the current pattern that we have. If I want to go ahead and label it, then we have this A that occurred here, and the B wave correction. Remember, it was an upward correction, even though everybody's used to corrective moves being downside. In Elliott wave land, a corrective move is a move against the previous impulse. So where we were last week, we were talking about in the recording where we came down here, we hit the 100% level, and then what normally happens is we go back up if we're going to have, because remember, we hit the 100% level, so we have satisfied this zigzag pattern. If we're going to have an extended C wave, what normally happens is we go back up and test the previous Fib level, which would be that 61.8% level, and then you move back down through the 100% and you have your extended move down to the 161.8% level. And expecting that to happen, I mentioned in the recording last week that that doesn't have to happen. It doesn't always happen. Even as a high percentage of accuracy as Elliott wave is, it's not 100%. Nothing is. But we took off our bearish put spread last week when we hit the 100% extension, expecting the bounce back up. We did get a bounce back up, but it didn't touch the line. And normally we actually physically touch the line. And you can say, well, that's being kind of picky. It was pretty close. But you want to be picky. You want to follow the rules as they're designed. And looking for that previous test, it didn't occur. So we came all the way down to the 161.8% level. And then we went to the weekend, and the expectation was Christmas Eve we would get the start of the Santa Claus rally, which usually occurs between the Christmas holiday and New Year's. And lo and behold, we went down again, breaking through the 161.8% level. So I went ahead and added the 261.8% level on there because that is a likely future target. It kind of reminded me of going back to when I very first got into Elliott Wave, which was this chart back in September. So you can see September 21st, we actually hit a 261.8% extension on the NASDAQ composite. This was shown to me ahead of time, the forecast, and I didn't believe it. I didn't believe that this could possibly happen. And there was the forecast chart. before 9/11. You can see that was on September 6th, and then we went straight down. Now notice the interesting thing about this is we didn't retest the previous fib level there either. It was a straight move down, but that was extraordinary circumstances, right? 9/11 was a pretty extraordinary thing. So the expectation is that following the normal course of activity, you follow the rules, you do the previous test, and you go on down. We even gapped down through here after 9/11, but that gap was because the market was closed, not an actual gap other than that. But so we came down and we hit the 261.8% level dead on. I keep this chart around. I visit it quite often just from a nostalgic reason because, again, this is the chart that made me a believer, and I've been focused on Elliott Wave ever since. That's literally the day I said, all right, I'm learning this stuff, and moved on from there. So with that in mind, we come back to this chart, and you can see that we have the 61.8% corrective level here. That just happens to be where that wave 4 was. So we had our first bounce today. The market had a pretty violent move back to the upside, but violent upward moves tend to happen in bear markets. In fact, the most violent upside moves usually occur in bear markets. I know it sounds strange, but that's the way it works out. So we had this move back up. So now are we going to come back to the 100% level? Are we going to go back up and test that 61.8% level? If we did, that would be right where the forecast wave 4 is. Now look where the 261.8% level is. Right in the middle of where the wave 5 forecast is supposed to go. So if we do come down to the 261.8% level, we satisfy that wave 5 extension as well. So it sets up almost too cleanly as far as what could likely happen. So are we going to continue up? Are we going to retrace this? Are we going to have the Santa Claus rally? That's the thing that brings the question to mind. But looking at this vertical move down, a lot of people are scratching their heads. I'm tired of hearing about the fact that it's the machines and the algorithmic trading and all that that's causing all the market to go down. The Federal Reserve is part of it, withdrawing liquidity and raising rates at the same time. But it's not enough to cause, in my mind, this sort of a vertical move to the downside. I wanted to show you this. I saw this today, and I found it to be interesting because I've been saying almost these exact words. Something is wrong. Something's not right by the fact that we are moving down so fast when, yes, there's some negative things out there, and we've highlighted them, but not this bad. But notice this chart. This is the S&P 500 and the Treasury yield. And look at how correlated they normally are. They usually move fairly close together, pretty much in lockstep. But look where we are now with the yields and the market with a huge divergence, a massive divergence. Yields are already coming down. We're very close to inverting the 1030 on the yield curve. We already inverted the 3s and the 10s, or the 3s and the 5s. So is it something unexpected out there? Is the market know something we don't know? I did a webinar several months ago called Black Swans, and what black swans are. And basically what it is it's an unforeseen event that happens and throws the market into turmoil, but it's just something that hasn't been already discounted in the market. The market is a discounting vehicle. It looks ahead. So what is this showing us that we don't know yet? Is there something really bad out on the horizon? I hope not, for all the people that are long only or have their money in managed accounts. But if you've been following along with us and you're following along with Elliott Wave, we've been doing very well to the downside and been making money all year. So you're doing great if you've been following along with this. So now the question becomes, do we move back up? So here's the plan. If we come back up and hit this 100% retracement level, I'm going to initiate a new put spread, and if we go up to the 61.8% level, we'll just take off the short puts and ride the long puts back down. Now, if we don't go back and test that 100% level, if we don't continue with this so-called Santa Claus rally, and we come back down, if we break the 161.8% level, I will also initiate another S&P put debit spread to ride the move down to that 261.8% extension, which is likely to occur. Now, it doesn't have to be as immediate as what's happened already, and with this vertical of a move, a bounce back up, especially this time of the year, all seems to make sense. But the market's going to do what the market's going to do, regardless of whether we think it makes sense or not. So I just wanted to give you ahead of time. Remember, we haven't done any Monday morning quarterbacking. We've been showing you all of our case studies and forecasts ahead of time, and then relaying how we've done, and we've done extremely well. One other thing I wanted to point out is on the SPY, where we can bring volume into the mix. We take a look at volume, and remember that red line's the 200-day moving average. You can see we had good volume on the bounce back up today, but on Christmas Eve, where we had that big downward move, again, the worst Christmas Eve in the history of the markets, you can see that the volume line was above average. But you're looking at it and say, well, that's nothing fantastic. But think about it, the market was only open till 1 o'clock New York time. And I've been mentioning that we haven't had that cathartic sell-off on big volume, the capitulation that everybody talks about. But maybe we could have on Christmas Eve, because that's actually massive volume considering that the market was only open half a day. If it had been open the whole day, who knows how big that volume spike might have been, especially on the downside move. Short sellers are known to be savvy. In fact, a lot of people really respect them and feel like in a lot of circles, excuse me, that they're even possibly a bit more savvy than long-only traders are. So maybe they snuck that one in on Christmas Eve on the big downward move, and that was the capitulation, and then they started their covering already. We'll see if that's what this move was today, but short covering moves are violent as well. So we've got a couple of things going. We got a violent upward move in a down market, and we've got the fact that usually starts at least a short-term impulse move back higher. So it's going to be very interesting to see how things play out. We'll do another update before New Year's, just because there's so much going on and the market's moving so fast. So I'm not going to wish everybody a Happy New Year yet. We'll talk again before New Year's. So watch for another update recording, even if we just focus on the market itself. I wanted to show you the VIX. Remember, we had this big descending triangle in the VIX, and we got the breakout move. And mentioned that we hadn't seen that big spike in volatility. Well, we did. With that move on Christmas Eve. We got up to 36. It still wasn't quite as high as what happened in February, but again, the market wasn't open all day. Would it have been if the market was open? Interesting questions. And then we came back down today, but we have very elevated volatility, so the market's going to be pretty wild considering what is usually a slow time. We don't usually have this week between Christmas and New Year's with a VIX in the 30 range. I also wanted to show you from a learning standpoint. Last week we mentioned that we had closed out 2 of these case studies immediately as soon as they broke the trend line, and I just wanted to show you why it's prudent to do that, because look what would have happened if we would have been hoping that they came back. You don't trade on hopium. You follow your rules. It broke the trend line, so we got out. So those were very smart moves to take quick short losses. That's how you become successful over the long term. The case study that we presented last week was here, Texas Roadhouse, and we did break that. We've got that big, huge descending triangle here. A lot of people think descending triangles, again, mean a downward move. We've already talked many times about how that's not proven by any statistics or facts. And so there's the series of lower highs. We did break that level on Friday, and then we had the follow-through day on Monday, and then back up today. Are we just going back up to test that level? We'll wait and see. There's plenty of time in this trade, but it's going to be interesting to see which way this one ends up going. Does it have enough oomph to actually have an upside big breakout move if we do have the so-called Santa Claus rally, or is that just going to be enough to test, maybe fill in a little bit more in this point before heading lower with whatever the market has on its mind moving into January after we get past the very first part of the year. So again, the unbelievable accuracy of Elliott Wave showing these. You've seen them. You know that what we've been talking about in the previous recordings. If you haven't updated your data, give yourself a present for the New Year's and follow along with us, and let's go make some money next year following along with Elliott Wave and these patterns and case studies that we've been showing you now for a year. So again, I'll talk to you before New Year's, and so hope everybody enjoys the rest of their holiday season. Take care, everybody.